Okay, welcome back to Accounting 401, Taxes and Introduction to Taxes in Chapter 11, where we're going to be discussing the disposition of assets and recognizing gain or loss. All right, it's pretty straightforward. As you would think, the amount realized is the cash received plus the fair value of any property involved in the transaction that you're receiving. Any assumption by the buyer of liabilities less the selling expenses, those are the amount realized, the proceeds realized, and you compare that with your basis in the asset. Okay. The difference, if it's positive, it's a gain. If it's negative, it's a loss. And if it's zero, there's no gain nor no loss. Okay. Now, there's a difference between different types of assets. Okay. And the holding period. Okay. So first thing they have there, and the topic is determination of the adjusted basis. Okay. Again, that would be what you paid to acquire the asset less any cost recovery depreciation taken on it. And before you get rid of it, you have to, excuse me. Excuse me. Before you dispose of the asset, you should update the cost recovery or depreciation on it. All right, excuse me. Now, if you receive the property as a gift, presents a little bit different scenario. Oops, I went down too far. Hold on. I have two ebooks I'm using this semester, and they're by different publishers. And the other one doesn't respond very well at all to turning the pages, advancing, or going forward or backward on the book. This book with McGraw-Hill is very sensitive. I like the McGraw-Hill one a lot better. Okay. A gift, again, is a transfer of property without giving any consideration, paying for it. The initial gift of the property to the recipient depends on whether the value of the asset exceeds the donor's basis on the date of the gift. Okay. So this is the donor, the person giving it. Okay. So if the market value of the asset on the date the gift is made is greater than the donor basis, then the asset initial basis to the recipient of the gift will be the same as the donor's basis. They don't allow you to recognize the appreciated value on a gifted asset. Okay, so if the fair market value of the asset is greater than what the basis is to the person giving the gift, then the person receiving the gift will just use the donor's basis in the gift. Otherwise, the IRS would lose, the higher value would be give a larger depreciation expense, and the receiver of the gift did not shell anything out. So why should they be able to have a stepped up basis? Greater depreciation expense, lower income. IRS doesn't like that. Now, if the donor's basis is greater than the fair market value of the asset at the date of the gift, then a special dual basis rules apply. That means the gift property has one basis to the donee if the donee sells the property at a price above the donor's basis, and a different basis if the donee sells the property at a price below the fair market value as of the date of the gift. Okay, so again, what they're trying to do is minimize any tax benefit to the receiver of the gift. Now, this means that the donor will not know the basis until they sell the property. That's where it gets tricky. Okay, so the basis of gifted property that has declined in value depends on the sales price of the asset subsequent to the gifting. The donor uses the carryover basis if the asset is sold for a gain, whereas the donor uses a fair market value if the asset is sold at a loss. Okay. If the asset sells at a price between the donor's basis and the fair market value, then the donor's basis at the time of the sale is equal to the selling price, and they don't recognize gain or loss. Okay, this prevents the transfer of unrealized loss from one taxpayer to another by using gifting. Okay, so that's the tricky part there. Inherited property. It's a little bit easier. For inherited property, general rule is that the heir's property's basis in the property passing from the decedent to the heir is a fair market value on the date of the decedent's gift. This is an important thing, not only in this course, but in your real life. Oftentimes, people that have elderly parents, the elderly parents will sell the property to the children or relative, nieces, nephews, whatever, for $1. Well, if that's the case, then their basis in that asset, in that home and land, is $1. And should they sell it later on for, say, $500,000, they're going to have a $499,990 gain. And they're going to have to pay a heck of a lot of tax on that gain. Where if you say, no, mom and dad, or no, aunt and uncle, don't sell me the property for $1. You keep it and let it come to me from your estate settlement. And then, if they paid $100,000 for the house 40 years ago, and now it's worth $500,000, and the date of their death, your basis is $500,000. So if you sell it for $500,000, you have no gain. Or if, let's say the basis was $400,000. You inherit it at the fair market value at the date of their death, $400,000. You sell it for $500,000. You'd have to pay a gain on the gain of $100,000. What would you rather pay tax on? A gain of $100,000 or a gain of $499,999? I think that answer to that question is self-evident. So again, everybody likes to do this until they talk to a lawyer or an accountant who tells them that's the worst thing you can do. Now, property converted from personal use to business use. See, you got all this stuff in all these situations that you don't dream of that come up in real life and business. You think, well, company has assets that they bought them on. No, sometimes they're gifted, sometimes they're inherited, and sometimes they transfer from personal use to a business use. So when you convert it, it depends on whether the property has appreciated or declined in value. If it appreciated, that is, the fair market value at the date of conversion is greater than the taxpayer's basis in the property, the taxpayer will use their basis to calculate depreciation and gain or loss on disposal. For property with a basis greater than value, the taxpayer may try to convert non-deductible personal loss to business losses by converting the property into business property and then selling it. So to prevent that, we have the dual basis rule. Again, if the fair market value at the date of conversion is below the taxpayer's basis, we'll use the fair market value at the date of conversion. Okay. If the fair market value at the date of conversion is also the basis used to calculate depreciation on property that has declined in value, they will subsequently sell the property at a gain or a loss. After conversion, the taxpayer adjusts the basis, whether gain or loss, for depreciation deductions from the date of conversion to the date of disposition. If they sell it and it falls in between, and the sales price, so the taxpayer does not recognize a gain or loss on the sale. I want this one after I say it's so much better than the other. So they show you an example here, and again, this probably make it a lot clearer when you can see some numbers and words. Okay, Steve received 100 shares of FZL stock from his grandfather on January 8th. Date of the gift, the stock was worth $15,000. The grandfather originally purchased it 10 years earlier for $10,000. What's the basis? Okay, because the stock has appreciated in value. Steve's grandfather owned it. Well, Steve's grandfather, you get grandfather's basis in it, $10,000. Okay. What if, assume that on the date of gift, the market value was $8,000? What is Steve's initial basis? Well, it depends on what he later sells it for. This is the dual basis rule. If he sells the stock 6 months later at a price greater than 10,000, his basis is 10,000, the carryover basis. He will recognize long-term capital gain because the holding period is over 10 and a half years. Even if you use carryover basis from grandpa, you pick up your date of acquisition is grandpa's date of acquisition. So even though he only had it for 6 months, he will get long-term capital gains on it because with the carryover basis, the date grandpa got it is the date we use for having it, or our owning it. If we sell it for less than 8,000, the basis is 8,000, the fair market value on the date of the gift. Okay. Again, you can read the other what ifs situations in there. It's pretty neat, and I think it will greatly aid your understanding. They got a lot of them there, what ifs. Okay. So adjusted basis is the initial cost less the cost recovery, allowed or allowable. Some people screw up the depreciation or they don't take it a year. You still have to treat it as if it was depreciated. It's a quirk in the law that gets a lot of people, and that can really have a different basis if you don't depreciate it or don't depreciate it as much as you should. Yeah, come on, this thing can keep. Realized gain or loss. Okay, gain or loss is the amount realized less the adjusted basis. Simple as that. So they give you some examples on that. And Exhibit 11.3, gain or loss, the amount realized. And again, when you're just disposing of it, sometimes you're getting another asset or a similar asset, and you may assume the debt if it's a piece of equipment that has been financed or property that is subject to the mortgage, and you assume the mortgage. So if you're looking at a $300,000 property and it has a $50,000 mortgage remaining on it, and it's a low rate mortgage and you don't want to refinance at higher rates, so you can make a deal with the seller that you're going to assume the mortgage, and that's going to lower your basis because asset minus the liability. So if it was $400,000 and it's got a $50,000 mortgage balance remaining, your basis is $350. Oh, you'd add it. I'm sorry, you'd add it. There it is in Exhibit 11.1. Cash received plus fair market value of other property received plus the assumption of the seller's liability, less the seller's expenses. Down here in Exhibit 11.2, they show you some things for Teton assets. And the assets, their initial basis, the amount realized on their disposition, accumulated depreciation. So you get the adjusted basis and just compare the amount realized with that adjusted basis, column 1 and column 4, the difference, and there you have the gains and losses. Okay. Recognize gain or loss. Key facts: the amount realized less the adjusted basis, realized gain or loss reported on the taxpayer's current year income. Okay. Turn the page to 147, 11-7. Character of gain or loss. This is important, very important, because long-term capital gains get preferential treatment, and also we have to report them differently, different forms. Okay, in order to determine how to recognize gain or loss, how it impacts your taxable income, you must determine the character of the gain or loss. Is it an ordinary gain or loss, or is it a capital gain or loss? Okay. Ultimately, every gain or loss is capitalized that way. Businesses may recognize what we call Section 1231 gains and losses on property disposition, but these are eventually going to be either short-term, ordinary, or long-term capital gains. Short-term capital gains is ordinary income, ordinary rates. Okay. So ordinary assets are assets created or used in a taxpayer's trade or business. Okay. Your delivery trucks, your tools, your machinery, your warehouse, your garage. You keep the delivery trucks in. Capital assets are assets that are held for investment purposes. Stocks, bonds, gold, collectibles, derivatives, mutual funds, that kind of thing. Okay. So 1231, section 1231, what they call 1231 assets, those are depreciable assets and land used in a trade or business held for more than 1 year. Okay. Later on in the chapter, they'll talk about section 1245 and 1250 property. That's tax lingo. That's a section of the code that applies to certain types of assets, mostly what those are. So again, property can be used in a trade or business, treated as inventory or accounts receivable, held for investment or personal use. Okay, so Exhibit 11.3, the characteristics there. If it's short-term, 1 year or less, long-term would be more than 1 year, 1 year and 1 day or longer. Then they tell you it's trade or business, it's ordinary income, or if it's long-term, then it's section 1231. And inventory and receivables are always ordinary. You can't get capital gains treatment for them. Investment personal use assets, again, short-term and long-term rules apply. Oops, again. See, I used the other one this morning and it wasn't as sensitive. This one is. So Exhibit 11.4 gives you a recap there. Capital asset, something held for investment purposes and or for personal use are capital assets. Now, if you have a capital loss, you can deduct up to $3,000 of net capital loss against ordinary income. And if you don't use it all up, you can carry that forward indefinitely. C corporations are not allowed to deduct net capital losses, but they are allowed to carry them back 3 years or forward 5 years. Exhibit 11.4 has a review of capital gains and losses. Very nice summary there. Section 1231 assets. These are the assets used in a trade or business, okay, including rental property, and it has to be held for more than 1 year. So it's going to be long-term capital gain or loss. Oh no, 1231 gains and losses carried as ordinary or capital on a taxpayer's return. How could it be ordinary if it's over 1 year? Okay, when they sell multiple assets during the year, you group them, you combine them, and you net them. There you go. Net gain is treated as long-term capital gain. If the netting results in a loss, then loss is treated as an ordinary loss. Okay, because net 1231 gains are treated as capital gains. And so how can they say it could be ordinary if it's a loss? Okay, gains are going to be long-term capital gains. So section 1231 assets are tax favored assets because they're going to, if you sell them at a gain, you get taxed at a lower rate. Now, gain on individual depreciable assets may be recharacterized as ordinary income under depreciation recapture rules. The theory there is they allowed you to take a deduction while you're using the asset or held the asset. And so now any deduction you took on that asset, you have to now pay tax on the recapture. So you can, after the recapture, then you got to again look at whether you had a gain or loss. Okay. Example 11.5 will walk you through that with the amount realized and the adjusted basis. You got a gain of 100,000. And then, so what if you sold land for 50,000? Your basis is 75. You'd have a $25,000 loss. Ordinary income. Assume the land was only asset sold during the year. It would still be a Section 1231 loss. Ordinary loss. Depreciation recapture. It's the conversion of a 1231 gain into ordinary income on the sale or exchange based on the amount of the accumulated depreciation on the property at the time of sale. So they allowed you to reduce your taxable income through the MACRS system, or if you straight lined it. Now comes the time to recapture that. Years ago, I had a rental unit and I had depreciated it, and when I sold it, I got hit pretty good on the recapture because I sold it at a gain. And the recapture really hurt me tax-wise. If a taxpayer purchases an asset for $100, sells it 3 years later for the same amount, no economic gain. Okay. However, if they claim depreciation of $70 during the 3 years of ownership, they would recognize a gain of $70 on the disposition simply because the depreciation deduction reduced the asset's adjusted basis. Depreciation is an ordinary deduction that offsets income that would otherwise be taxed at ordinary rates. So, absent any rules to the contrary, special rules for special situations, the asset would be treated as a long-term capital gain and would be taxed at preferential rate. Thus, the depreciation saves taxes at the ordinary rate, but then the gains creates a long-term capital gain. So to do that, they develop this thing called recapture. Recapture applies. It changes the character of the gain on the sale of a Section 1231 asset from a 1231 gain into ordinary income. So the amount of the recapture of the depreciation is ordinary, and then any amount above or below that could be long-term capital gain. So they give you Exhibit 11.5 there, and they show you how the three types of assets. Pure Section 1231 land, 1245 would be personal property and intangibles. That would be your vehicles, your machinery. And 1250 is depreciable real property. That would be the buildings on the land. Okay. Section 1240 property, personal property, and amortizable intangible assets are 1245 assets. Okay, tangible personal property. The lesser of the gain recognized or the accumulated depreciation is recaptured and recharacterized as ordinary income. Okay, so they're not going to allow you capital gains preferred rate because when you depreciated it, it offset ordinary income. It reduced taxable income, which was taxed at ordinary rates. So anything above that would be a 1231 or long-term gain, and there is no depreciation recapture on assets sold at a loss. So we don't have to worry about it. Tangible personal property, and I give you examples: machinery, equipment, automobiles, amortized intangibles are known as Section 1245 property. Okay. The gain from the sale of 1245 property is characterized as ordinary income to the extent that the gain was created by prior depreciation or amortization deductions. Okay, so same thing. The property, let's see, they sell Section 1245 property. The amount of ordinary income they recognize is the lesser of the recognized gain on the sale or the total accumulated depreciation on the asset. Okay. So they give you three scenarios there. Created a gain solely through depreciation, recognize a gain created through both depreciation and actual asset appreciation, or they recognize a loss. So we'll walk you through on the next page the examples for each one of those scenarios. So again, let's repeat those. Three possibilities. You can recognize a gain that is created due solely through the depreciation. Okay, recapture, ordinary income. You can have some of the gain from depreciation, and any above that would be actual appreciation on the asset. That would be long-term capital gain if you held it for more than a year. And then if you sold it at a loss, you don't have to worry about it. Exhibit 11.6, again, they're trying to show what they're describing the words there graphically. You see the adjusted basis and then scenario 1, 2, and 3 there. So ordinary income because of recapture. And then in scenario 2, you have some ordinary income due to recapture. And you have some capital gain in the dark green up the top. And then the scenario 3, you have a loss. Section 1250, depreciation and recapture for real property. This is a throwback. There may be some buildings out there, some Section 1250 property that this affects. We're pretty close to being having the calendar eliminate this thing, because it would have to go with the old real estate depreciation tables. Under the new current law, about 2/3 of the way through that paragraph, real property is depreciated using a straight line basis, so because there might be some weird, strange places, the scenarios where it may factor into it. What it has to do with the prior to MACRS, they had the ACRS, Accelerated Cost Recovery System, and before that they had the GDR system in place for tax depreciation / cost recovery, and they had accelerated methods for real estate. And then when they changed it in, what was it, 79 or somewhere in the 80s, they went straight line with it. So you can read that, but again, there's not, by all estimates, there's not too many pieces of real estate out there because they are more than 40 years old. Unrecaptured 1250 gain for individuals. Okay. Except for assets held 12 months or less. Neither corporations nor individuals recognize 1250 recapture on the sale of 1250 property when it is sold at a gain. Instead, corporations use Section 291 recapture. Individuals, however, do not recognize ordinary income from the sale of 1250 property when it is held long term. It would be subject to long-term capital gains rates. Okay. I'm going to look for a date. I'm surprised they haven't put the date in here. And again, look at the key facts. The last one, uncaptured 1250 property is 1231 gain. That if ultimately characterized as a long-term capital is taxed at a maximum of 25%. So it does get the preferential treatment if you're in the higher brackets. Tax at a maximum. So it's always going to be capital gains depending on where you are in the taxable income bracket. It'll usually be one bracket below your marginal tax rate. Let's see. Tax policymakers have determined that a portion of the gain caused by the depreciation deduction, reducing the basis, called unrecaptured 1250 gain, always be held more than a year, and this gain is taxed at a maximum of 25%. So they show you there the 0%, 15%, or 20% rates generally applicable to long-term capital gains. And that maximum rate of 25% is the lesser of the recognized gain or the accumulated depreciation on the asset. There are some limitations to it. The remainder of the gain would be at the normal long-term capital gain rates given a person's taxable income. Gains, characterizing gains on the sale of depreciable property to related parties, related persons. Again, they're trying to do here is prevent people from structuring transfer of property, transfer of assets, just for tax purposes to take advantage. So they'll shut down the rules here. All gains recognized from selling property that is a depreciable asset to a related buyer is ordinary income. So you can't get capital gains treatment for it. Related parties are defined as an individual and the individual's controlled corporation or partner, a taxpayer, and any trust in which the taxpayer or spouse is a beneficiary. Okay, so when you sell it to related parties, Section 1239 comes into play, and it means it's going to be ordinary income. No way to get long-term capital gains out of it. And again, that is to prevent people from finagling things to get a capital gains treatment. They give you a schematic there. That looks something like it belongs in an electrical engineering course. That is something like what you would see in some of the IRS publications. It's really not that bad if you take it step by step. And you're answering yes or no, and it tells you where to go. And then you finally come down to the bottom, and it tells you what it is and how to treat it. Calculating 1231 gains or losses. Again, for individuals, asset dispositions are annually netted together, and net 1231 gains may be recharacterized as ordinary income under the look-back rule. Again, we're trying to minimize the advantage a person can take by structuring and timing a sale of disposition of assets using creative tax strategies. Section 1231 look-back rule is a non-depreciation recapture rule that applies in situations like the one we just decided to turn what would have been a 1231 gain into ordinary income. It affects the character, but not the amount of the gain. Okay. So it's just disallowing the long-term capital gain treatment, which would give you preferential tax rates, and saying it's going to be taxed at your ordinary marginal tax rate. Okay. And give you some examples there in 11-13. It's an interesting case there with the ethics box. She has a realized gain on the equipment, and realized a $10,000 loss on the equipment and $15,000 gain on the land. So she talked to her accountant, wants to game the system a little bit and avoid any negative effects. She wants to sell the land this year and then sell the equipment early next year. You could sell it on December 31st and the equipment on January 1st. You think about her strategy. It's clearly a tax. It's done to evade taxes, so the IRS is going to say, no. Can't do that. So Exhibit 11.8 is another schematic that shows you how to walk through that, and determine whether it's ordinary or capital gain. And I give you the 3 steps in that process that is shown schematically there. And here's a summary for gains and losses for Teton, the example they use. And just crazy how many changing colors. There it goes. So You see class by class, and here we see Form 4797, which is the sale of business property. And if you look at the forms, they're somewhat intimidating, but if you take your time and read through them, Part 1 is for the sale or exchange of property using a trade or business held for more than 1 year. If you look at line 9, after you do all those other lines in the columns, subtract line 8 from line 7. If 0 or less, enter 0. If line 9 is 0, enter the gain from line 7 on line 12 below. If the enter the gain from line 9 as a long-term capital gain on Schedule D. So it tells you where to, this form is sort of like a worksheet, and from it, it will distribute amounts to other forms. Part 2, ordinary gains and losses. Those would be held for less than a year. Okay, less than 1 year. Held 1 year or less. Part 3, gains from disposition of property under sections 1245, 1250, 1252, 54, and 55, and then you have to list them. And then you work down the columns. You might have to use several pages of this 4797 if you have more than 4 pieces of property. This company only had 3. And then it tells you, where to put it. Well, right next door to it, or right underneath it, is Exhibit 1111, which is the Schedule D. And you can see where the number comes over to line 11. And let's see, gain from Form 4797, Part 1, long-term capital gains. And you can scoot back up and see where that $177,500 came from. So those two forms work in concert together. All right, tax-deferred transactions. When you replace a piece of equipment, you trade it in on a similar piece of equipment. All you do is adjust the basis of the new equipment for any gain or loss. Okay, so you get to defer recognizing the gain or loss. These are called like-kind exchanges, or Section 1031 exchanges. Like-kind exchange is a non-taxable or partially taxable trade or exchange of assets that are similar or related in use. Similar or related in use. That means you can trade a car for a pickup truck. Again, there's a lot of literature on this of what is a similar or similar use. They won't go to the extreme that they, an airplane, general aviation aircraft, the corporate jet, and a delivery truck are both pieces of transportation equipment, but they are not similar in nature. Okay. Like-kind exchanges can provide taxpayers with significant advantages. Yeah, because you can put off paying the tax to when you eventually get rid of that asset, the new asset you're acquiring in the exchange, and you can do it time and time again. So you can put it off for, let's say you replace some of your fleet every 5 years, and you keep turning it over. You can do it almost infinitely. When you get rid of it for a non-like-kind asset, then you would realize and recognize the gain or loss. For an exchange to be like-kind for tax purposes, you must meet all the 3 criteria. When it's real property, it must be exchanged solely for like-kind property. For both real property given up and real property received, the exchange by the taxpayer can be either used in the trade or business, held for investment. The exchange must meet certain time restrictions. So they summarize that. What's ineligible, or what's eligible? Real property. All real property, and that would be any type of building and land. What's not eligible? Personal property, domestic property exchange for property used in a foreign country, real property held for resale, because that is more in the nature of inventory than land held as an investment. The property use. Even when property meets the definition of like-kind, property can exchange property in a qualifying like-kind exchange only if they use the transferred property in a trade or business or for investment, and they will use the property received in exchange in a trade or business. Okay, they could exchange its warehouse on 10 acres for a 200-acre parcel, and it intends to hold as an investment in qualifying like-kind exchange because they're using the warehouse in the business and will hold the land as an investment. However, if Steve, an individual, exchanged his cabin in Maine for a personal residence in Wyoming, the exchange would not qualify because it was used for personal purposes, and he would be using the Wyoming property for personal rather than business or investment property. He rents out his cabin, which is a investment property, and exchanges it for a principal residence in Wyoming. It's not a like-kind exchange because one is an investment and one is personal. Yeah. Timing requirements. Like-kind property exchanges may involve intermediaries. Taxpayers must identify replacement like-kind property within 45 days of giving up their real property. So 45 days in a land transaction, you better have it lined up. Like-kind property must be received within 180 days of when the taxpayer transfers real property in a like-kind exchange. Okay. Tax consequences. We've discussed the exchanging property that you need to meet the like-kind exchange requirements. They do not recognize gain or loss. They just adjust the basis. Okay. So you can defer the gain. Key facts. Sometimes you'll get what they call boot non-like-kind property in a transfer. So you'd have to recognize income on the gain when boot is received to the extent of the boot given. So if somebody gives you their 10 acres and $50,000 for your 12 acres, that $50,000 cash is non-like kind. So that would be subject to gain, and you would just pick up the basis of the land, you giving up, transfer that to the new piece of real estate you're getting. Reporting like-kind exchanges, Form 8824, and we have involuntary conversions. This is a little bit screwy because it depends on how it was lost. Involuntary conversions occur when property is partially or wholly destroyed by disaster or accident, stolen, condemned, or seized via eminent domain. Okay. Hurricane Harvey, Irma, Maria, wildfires in California, all involuntary conversions. Even when they experience loss of property like that, they might not realize a gain for tax purposes if they received replacement property or insurance proceeds in excess of their basis. They might realize a gain if they get reimbursed higher. Okay, taxpayers may experience tremendous financial hardship if they're required to recognize the realized gains in these circumstances. So let's say a building acquired for $100,000, building appreciates in value, it's now worth $150,000, destroyed by fire. Building is fully insured and at its replacement cost, so the business receives a check for $150,000. Problem is the business will realize a $50,000 gain on this involuntary conversion. Okay, so you got $150,000 in proceeds, your basis in the building was $100,000. So the assuming business's income is a 32% marginal rate, it would have to pay $16,000 and leaves only $134,000 to replace the building with $150,000. So Congress put some special provisions in called involuntary conversions. Gain is deferred when appreciating property is involved. Basis of property directly converted is carried over from the old property to the new property. Indirect conversion, gain recognized as a lesser of the gain realized, or the amount of reimbursement the taxpayer does not reinvest in the qualified property. Qualified replacement property must be of similar or related use to the original. Okay, so we have direct conversion, indirect conversion, and qualified replacement issues to be aware of. Again, the examples there, it will greatly help your understanding. Example 11-18. Installment sales. This is where we differ from financial accounting. Sale of property where the seller receives at least one payment in a taxable year subsequent to the year of disposition. Okay, a series of payments. We must recognize a portion of the gain on each installment payment. Okay, it's not like you can count all the payments until you recover the cost, and then after that, anything over and above is gain, which could be say you're doing a 5-year self-financing sale of a building, and you would not pay any tax the first 3 years, and the last 2 years you would have all the gain. No, each payment has to be prorated for cost recovery, recovery the basis, and gain. Gain from installment sales are calculated as follows. Gross profit percentage. Gain recognized as a gross profit percentage times the principal payment received in the year. Inventory, marketable securities, and depreciation recapture cannot be accounted for under the installment sale rules. And installment sales rules do not apply to losses. You got to take them as soon as you can recognize them. Gross profit percentage is gross profit divided by the contract price. It appears right there in that little tan box. Okay, they give you an example in 11-19, and we're going to have 4 equal installments, $25,000 a year for 4 years on $100,000 property. So you figure out the percentage, and then you prorate how much of that, each of those $25,000 payments, how much is gain and how much is recovery of the basis of the property. Gains eligible for installment reporting. Marketable securities or inventory may not use the installment method. Other deferred tax provisions. Cost of forming a corporation. You could immediately expense some of them, but anything above that, you could defer until you start making some money with that corporation. And related person losses. They are not deductible by the seller because you could sell, I buy a new Cadillac and give it to one of my relatives. It cost me $70,000, and I give it to them for $25,000, and say, hey, I had a $50,000, no, $75,000, $70,000 sold for $20,000. I had a $50,000 loss, and the IRS saying, no, it's a related party transaction. You can't recognize that loss, can't deduct it. Again, that'd be personal anyway. Now, on the other hand, there's a gain. They would jump in and say you have to pay tax on it. Of course, they make the rules. All right. Let's bridge. Oh, that is it. We're at the conclusion of chapter 11. Okay, one more week and we will call it a semester.